The government is shutting down. Should you sell your treasuries? Hello members, super savers and course fans, and welcome to Markets with Marcus. So, we have a government that's in shutdown mode after the two parties failed to reach an agreement before the deadline at midnight. And while government shutdowns are nothing new for us, we haven't had one in a while, so let's discuss 3 questions in today's video. 1. How did we get here? And what does the shutdown mean for your treasuries? 2. Are the markets expecting an economic crisis? And 3. What comes next? So, how did we get here? And what does the shutdown mean for your treasuries? So, in the US, as we all know, Congress has the power of the purse, as the saying goes, which means only the elected representatives of the people can decide on taxation and spending. And when the president and the administration wants to spend money, they need not 1, but 2 such permissions. First, they need a budget, or technically an appropriations bill, as the permission to spend the money. And because we are permanently short of money and need to borrow more, the government generally also needs an extra permission from Congress to borrow more money, to increase the current debt limit. So it's like a bit in a family, where you also need to agree on 2 things if you spend more than you earn. First, you need to agree on where you want to spend the money. Do you replace the old car that's about to be breaking down? Or are you fixing the roof that looks like it's about to leak? And you're spending more than you earn. You also need the credit card limit to go up, so to speak, to make either one of those things possible. And just like in families, when money is tight, there's often fighting around the money. And that's why we have regular shutdown crises. And this government shutdown crisis come in 2 flavors, with different impacts on our treasuries, at least in theory. So the first is a debt ceiling crisis. You will remember we had one of those in July, until the big beautiful bill increased the debt limit, which means the government can now borrow more again, and that should hopefully last us for a while. So if the government has to shut down because there's a debt ceiling crisis, the government can, in theory, keep spending money as it wishes, but it can't borrow new money, which is pretty much a constraint given that a fair proportion of our spending comes from borrowed money. And in a debt ceiling crisis, treasuries are not really protected. They have always been protected in the past though, so no government, no administration of either party has ever defaulted their treasuries in a past debt ceiling crisis, but there's always a bit of a risk. So the crisis we're having this time, for today, since yesterday, is a budget crisis, which means there's no spending authorization, and that's happening usually around the end of a fiscal year. And it's this time of the year again, because today, October 1st, is the first day of the new fiscal year. And by the way, the last time we had a full budget in time for the beginning of a fiscal year was back in 1996. So if you have a budget crisis, because there is no budget, no spending authorization, the government has to freeze discretionary spending. However, essential services can continue. We get back to those. The government has a bit of discretion there. And everything that's written in law, every entitlement continues. So social security payments will continue to be made. Medicare will continue to function. And, important for this video, treasuries will stay completely functioning, meaning payments for interest and principal can and need and will be made as expected if everything goes as planned, because those are written into law. So in such a budget crisis, there's no risks for your treasuries in theory. Now, sometimes markets get a bit nervous, and sometimes you still see blip yields, as we call them. So yields go up a bit, it's a bit of a risk premium in case something goes wrong or in case there are delays in payment. We saw them, we think, last week a bit at the short end, but not very much. And in fact, since Friday, we saw the opposite, almost the opposite. Because treasuries are mostly flat or down across the entire range, which seems to indicate that investors are buying treasuries. So the motivation is not always clear. Markets don't tell you why they are buying treasuries. But in a crisis, seeing treasuries being bought, more demand, prices up, yields down, that's what we're seeing, yields down, could mean that treasuries are still seen as a safe haven in turbulent times. And we're seeing this flight to safety, as we suspect, especially in the longer maturities, 10 years and longer. So what do you do with that? So if you're a buy and hold investor in treasuries, as we are ourselves, you can safely ignore it, mostly, I think. You just keep it, it'll normalize again, and as we all know and expect in our standard no default scenario, our interest will continue to be paid on time and we get a full principal repayment at maturity. If you have a trader mindset, you can look at it as an opportunity. For example, if you share our suspicion that this is a flight to safe havens, extra demand for treasuries, yields down, prices up, and that you think once the crisis is over, people will sell those treasuries again and maybe invest in equities because they're more lucrative. As a trader, you might even sell your treasuries now, park the cash, and maybe buy them again, repurchase them, so to speak, in a few days or weeks when everything has normalized. You may make some money with it. That said, that's really only for traders, and for normal retail investors like you and me, it probably doesn't make much sense. We're talking a few basis points only, single-digit basis points of what we've been seeing. So, my personal opinion is that we should be able to sleep soundly as treasury investors, regardless of what happens, given that treasuries are protected in such a budget crisis. However, one side note, one note of caution, there has been some noise, some media reports that we may have to wait longer for some economic data, maybe even until after a possible shutdown ends. So we'll need to see what it means for us, especially whether the publication of inflation data might get delayed. And if it gets delayed, what would it mean for I-bonds and TIPS, who are generally adjusted according to this CPI? Now, my personal assumption is, even if these data are delayed, that the government would handle it like they handle other payments. They will make up for it fully after the crisis, the government shutdown is over, but you never know, right? And I don't have a crystal ball either. But again, I can still sleep very soundly at night, even with a potential government shutdown, even with the starting government shutdown, because I assume treasuries will basically be not affected. So, but what for the economy overall? Are the markets expecting an economic crisis? Now, as I just said, as a treasury investor, I personally can sleep well at night. Maybe there's a small flight to safety, maybe that even helps a bit, but pretty much they shrugged it off. Similar for equity markets. They were a bit wobbly this week, up and down a bit, not too dramatic, but a bit up and down. And as of market close yesterday, they were even up a bit and closed September very strongly. So another sign that they're not really expecting a slowdown or an economic crisis, but potentially a continuing economic growth, maybe also a bit of a hope for rate cuts, who knows? No? But no signs of an immediate crisis or even recession. The dollar was down a few basis points, but again, I personally don't see that as a flashing red warning signs. It's essentially continuing a trend we've been seeing for the year. So overall, I think in summary, we can say that markets have been taking the government shutdown that's starting in their stride, shrugging it off, so to speak, for three reasons. First, we've had a lot of government shutdowns and funding gaps in living memory, so we're kind of used to them. So the official archive of the House of Representatives counts 10 episodes over the past 40 years in which the administration had a funding gap. Now, 2 were too short and too mild to trigger a shutdown, but 8 of those episodes saw a government shutdown being started. So basically one government shutdown every 5 years. The last one was in President Trump's first administration from end of December 2018 to January 2019. So a bit more than 5 years ago. And now one might almost be tempted to say it's been time for another government shutdown. We haven't had one in so long. So the second reason why markets seem not to be too worried about the shutdown is that generally they don't last that long, or at least not long enough to do lasting damage. On average, these 8 shutdowns over the past 40 years lasted a bit more than 10 days, 10.4 days. And the last one was even the longest, the 2018-2019 one, at 34 days, the longest shutdown in history. Now, no one can predict the future, and past performance, as we always say, is not indicative of future results, but the market seems to be expecting a shortish shutdown again. As we see this headline from one analyst who may be speaking for the market, we expect a shutdown of at least 1 week, though probably 2. So if that was the case, that would be relatively manageable. So all fingers crossed. And then the third reason why markets don't really freak out over government shutdowns currently, that in the past, the economy has always made back its temporary losses. So what this means is that while government shutdowns don't bring the economy to a screeching halt, they do generally impact the short-term performance of the economy. There's general insecurity and uncertainty affecting the private sector. Government employees, federal government employees, are usually sent on a furlough, on unpaid leave. So there's a bit of market volatility, it doesn't help. So the government estimates that the 2018-19 shutdown, the long one, the record one in Trump's first administration, may have reduced GDP growth by 0.4 percentage points in the quarter when it happened. And in 2013, the Office of Management and Budget even reported that growth might have been 0.6 percentage points lower than it wouldn't have been without a shutdown in the period. Now, not great, but also not catastrophic. And in addition, after all these shutdowns, it looked like the economy was making back these temporary losses very fast after the government reopened and the economy recovered those losses, including private investment, private activity that had just been postponed. So that's where we stand. General picture, bit of worry, people watch it, but no panic yet in the market. And all fingers crossed it stays like that. So what comes next? There are now 2 things happening in parallel, and both, that's the risk here, have the potential for some surprises, positive or negative. So the first one is that as of today, the government shutdown procedure is starting, which means that the government now will send a part of its workforce on an unpaid leave, a furlough as it's called, and that is especially for non-essential workers. Now, who's essential, who's non-essential, who will be sent home, who won't be sent home, that is something where the administration has a lot of discretion and power to decide that. It's a bit of a power tool for the government, for the administration if you want. So the best guess we found is that the Congressional Budget Office estimates that about 750,000 federal employees, 750,000, could be furloughed in a shutdown, so sent home, sitting at home. In addition, even those who have to work remain unpaid while the shutdown is going on. So not nice either for those who are affected. That said, in the past, and that's still the baseline here, all federal workers in the past got fully paid once the government reopened. No, in arrears, so were made completely whole. There are still some groups who may lose a bit of money, especially contractors, who I think usually weren't paid in the past. So far so usual, so predictable, so unpleasant, but hopefully not catastrophic. So where we might see a surprise or not is that President Trump has been threatening not to just furlough people, not just to send them on unpaid leave, but to make them redundant, to fire them essentially, and maybe to cut entire government programs. That might be possible, given that the administration, via the Office of Management and Budget, has a lot of discretion and power during a shutdown, but it would be untested territory. Again, in the past, there were only furloughs, everyone got rehired, got their back pay. So we'll need to see whether it comes to firings. If so, if they will withstand a court challenge, that would most certainly follow, and if and whether that happens, what the economic damage would be. So that's clearly one risk to keep in mind. So the second thing that's now happening is that the political discussions will continue about how to resolve that government shutdown. So where we currently stand is that the House of Representatives has approved a continuing resolution with its majority of Republicans that would just roll forward the current spending for a few weeks only until November 21st. They call this a clean continuing resolution in the sense that it just rolls forward whatever is in the books currently, extends the deadline, but doesn't change anything. Now, the Senate has been blocking this clean continuing resolution, and that's possible because even though the Republicans have a majority of 53 senators, they would need 60 to overcome the Democratic filibuster. So, Democrats are demanding a few concessions, more spending, not just a rolling forward of current rules. And at the core, from what I could gather, is the demand to extend the extra Obamacare subsidies that were enacted during COVID. So these would expire at year end. So it's early to extend them, but that seems to be the core demand. There's also a list of additional demand, including taking back some Medicaid cuts and so on. But it seems that Democrats have been signaling flexibility of those. So again, we'll see where this goes and how long it will take to resolve it. But no, personally, I wouldn't be surprised if we saw a resolution along the lines that maybe we get a continuing resolution for a bit longer, not just for a few weeks, and maybe an extension of the Obamacare subsidies already now, or some variation of that. And while that happens, I also personally expect to see more ups and downs in the market, more volatility, more noise. But again, just to say it once more, at this point, I'm not too worried about either our economy or our treasury holdings. But again, who knows? I don't have a crystal ball either, and we'll definitely keep watching what happens here at Diamond NestEgg. So, what do you think will happen? Are you buying treasuries, selling treasuries, or just holding still at the current? Drop us a note below and share your thoughts with us and the community. So members, super savers and course fans, that was it for now. Let's see what happens. All fingers crossed. And I hope to see you again soon on our channel.